Hi everyone, I'm Trisha from Unit 21 and really excited for our webinar today where we will be diving into our annual report on state of fraud and AML. This is the third year that we've released this report, and I'm really excited about the data here because a lot of the data is it really dives into the problems and the trends in fraud and AML, but there are some really surprising takes that I am really excited to dive into with this group here. What we are going to do is dive into the three key trends that are impacting fintech companies. The report is going to be released at Money 2020. So this is really a preview before Money 2020. So really excited for us to give you a quick sliver into what we are seeing in the data and discuss it with the experts here. All right, let's get started. Thank you again for joining me. I'm co-founder and CEO of Unit 21. If you are not familiar with Unit 21, we provide anti-fraud and anti-money laundering software for fintech companies and financial services companies. We have three key products. We have a transaction monitoring product for fraud and AML to identify fraud in real time or to be able to write, test, and deploy AML rules. We have a case management product for fraud and AML operations teams, which includes reporting for SAR filing and for regulatory compliance. And then we have a consortium product. The consortium is a shared blacklist, if you may. And we are really excited about its growth. That's our newest product. We launched it a year and a half ago. And today we have 61 companies live and contributing to it with coverage of over 40 million American adults. And today we work with companies in the US and around the world. We work with a wide variety of companies in the neobank space, companies like Chime. We work with companies in the payment space, companies like Gusto. We work with companies in the crypto space, companies like crypto.com. We work with marketplaces like Patreon. So a lot of the data that we have here that we'll be talking about covers fintech and a very broad term that includes all of the different segments that I mentioned. So really excited about what the breadth of the companies that we're going to be talking to that we've gathered data from will be covering. Finally, we are recording this, and there is Q&A that you can ask via chat, which we will respond to via chat as well. All right. Without further ado, let's get started. I want to take time to introduce our three panelists today. So let's kick it off with Jason.
Yeah, thanks so much for having me, Trish. My name's Jason Mikula. I've spent about 10 years or so in the consumer credit space before transitioning to fintech and banking advising and consulting, as well as publishing industry newsletter, Fintech Business Weekly.
Awesome, Jason. Wonderful to have you here. Frank.
Oh, great to be here. Thanks for having me. My name is Frank McKenna. I'm the Chief Fraud Strategist, also the co-founder of Point Predictive. Been in fraud management for 30 years, and I write a blog called Frank on Fraud. So I'm excited to be here today to talk about what we found on your report. So thanks for having me.
Thank you, Frank. Frank on Fraud is my Bible, as I'm sure it is for a lot of people on this call. So thank you for everything you do to help expose this community to the latest fraud trends, and excited to dive into more of this with you as well. And Chris.
Well, thanks very much, Trisha, and it's great to be here with Jason and Frank, and really looking forward to the conversation. I'm a partner at FS Vector. I've been in the fin crime space, AML, fraud, sanctions compliance for probably close to 20 years of my career, working with large banks outside the US and lots of fintechs here, and of course FS Vector is a fintech advisory and advocacy firm based in Washington, D.C. We work with crypto firms. We work with traditional finance firms, fintech, payments, lending, you name it, and a number of banks in the fintech space as well. So really excited to be here and join the conversation.
Awesome. Wonderful to have you, Chris. We work with FS Vector a lot, with a lot of our joint customers, and I'm excited to dive into what you are seeing and working with a variety of fintechs. And Jason, if you don't know, has done incredible work in uncovering a lot of the problems and challenges with fintech and how it's set up. So it'll be really fascinating to hear his takes on some of the top three takeaways. All right, so let's dive in. But before that, just to quickly share, we surveyed nearly 200 fintech companies this time, which is our largest segment of fintech companies that we've ever surveyed. Um, and that include a really wide variety of fintech companies. It included payment companies, crypto companies, neobanks, BaaS services, and I would say other. Fintech is so broad; it really is an umbrella word, catch-all for technology applied to financial services. So there's a lot of different types of companies that we talk to, and companies with different ranges of customer sizes as well. Um, So we have, I would say, a lot of companies, the highest number under 1 million customers, but we have a good number of companies that are 1 to 100 million and 100 million and above. And our focus really was on fraud and AML. So we have a lot of the respondents who were either doing fraud or AML, but it was interesting. About 10% of the companies, the analysts that we surveyed, they belong to FRAML, which is a combination of fraud and AML. And so about 10% of the companies had fraud and AML be one department that was serviced. And we surveyed across the board. We surveyed analysts, we surveyed on the VP side as well as the executive side. So it'll be interesting to dive into this data from the perspective across the board, from people who are looking at the reports, making high-level strategic decisions, as well as people on the ground tackling fraud every day. All right. The first big takeaway was that the largest fraud concern is the surge of scams. And we have seen scams increase significantly. In fact, even at Unit 21, since the rollout of ChatGPT in end of 2022, we have seen an insane increase in scam activity. I'm sure everyone has received some version of a Nigerian prince email, and it's a scam because there's punctuation errors, there's spelling mistakes. It it just seems so not um, based in reality. So people know that it's a scam, but now with AI, the scams can get really sophisticated really quickly, and we are seeing scams across the board. We see voice AI scams where uh, scammer is posing as a granddaughter, calling her grandmom and saying, "Hey, I need $10,000 and to my friend. Please don't tell mom and dad." And the grandparent, out of love, will give the money, and I see a lot of money being lost through scams like that. We also see scams on the business side with business email compromise, where people are able to get access to business emails and then be able to transfer funds to themselves. So there's a lot that we are seeing across the board, whether you're a business or a consumer, in scams. And this is the biggest growing threat in financial services, according to the FBI as well. So I would love to call on Frank. What are you seeing from running Frank on fraud for many many years? How has scams changed in the last couple of years, and what are you seeing as the biggest threats?
Yeah, I think you picked up on some of this, Trish, when you were talking about AI, and I think AI and automation is playing a huge part in this. A couple examples: look at OTP bots. These emerged in July of 2021, and
Mhm.
they automated the ability to steal somebody's one-time passcode. Basically, these bots could go out and systematically call hundreds and thousands of people simultaneously, play an audio clip pretending to be from the bank, and one out of every 50 people will punch in their one-time passcode that they received via the scammer when they tried to log in, and they're able to break into the person's account. So we saw a huge increase in that. That's driving a lot of the scams. You mentioned AI. I don't know if you saw, it was trending on LinkedIn this week, but Instagram automatic fans.
Mhm.
This is another technique where the pig butchering scammers are using artificial intelligence to contact victims via Instagram and via other channels and communicate with them as if they're real people in the scam. So we're just seeing a lot of automation. I think that's driving a lot of the increase in the
Mhm.
phishing and the things that you're saying. So it's only going to get worse, I think, is my prognosis here.
Absolutely. It's a growing problem and very, very sophisticated compared to even a few years ago. And what was surprising to me was we did the same webinar, but for banks, credit unions, community banks. And this was a trend that is there no matter what type of financial services institution you are. So whether you were a fintech or a credit union, scams is the biggest growing threat today in fraud. Um, and what we found is that, typically for scams, one does not necessarily have to today have to reimburse the victim. But we found that what was surprising to me was that companies are reimbursing victims a lot, even if there isn't immediate necessary liability to. And a big reason is customer retention. You don't want your customers to leave you they were because they got scammed and now they have a negative experience with your institution and they might leave. So that was interesting to me. I'm curious, Chris, what do you see in terms of how fintech companies are responding to when a customer contacts them about a scam? And the liability today is not on fintech companies, but how do you think the liability may shift, Jason?
Why don't I start, Jason, and then you can pick up from this one. On the scam point, and sort of stepping back a little bit from straight up fraud, if you think about the it was the sort of the cross section of people that were respondents to the survey, and we looked at like half or so are in the AML space, and another 10% in the fraud and AML space. Think about this from the AML perspective. It's not at all surprising that scams and fraud are a big ticket item. They've been for a long time. If you go back even to 2021, when FinCEN released its first set of priorities for things that it is particularly monitoring and sending out advisories about, fraud was certainly a big one then. They're due to come up with the next one in 2025, the next set of priorities. I would personally be shocked if fraud did not take at least as prominent a role, if not more prominent, in that set of priorities. And you're seeing it here, and you're seeing it sort of bottom up, like from the respondents and from the people who sort of live and breathe this stuff day in and day out. And if you think about this from then the AML perspective, if fraud is in one of those really big deals, it leaves these fintech firms and of course the banks in this sort of tricky spot where clearly it's a predicate offense. It needs to be reported. It needs to be addressed from a fraud loss mitigation perspective, but it leaves firms in a tricky spot because they need to decide how best to respond to this one. And that old line of, well, we're not really on the hook to deal with fraud losses, maybe gets tested and pushed a bit. And so a lot of our clients are asking this sort of question, like, at what point do we, from a reputational risk perspective or from a customer experience perspective, accept it and make that defrauded customer whole again. It's a tricky line, and I don't think there's a single answer for it, but it's one of those ones that continues to get litigated as these scams get more sophisticated, as the tools we have to deal with them and identify them get better. We'll increasingly be faced with these questions of like, how do we keep our customers satisfied and staying with us?
Yeah, I mean, to build on that and some of the points that Frank made, there's always the question of liability, right? And I think it looks like we've all been around the industry long enough to be familiar with some of the uh, older, IRS impersonation scams, law enforcement, impersonation scams. I came from the lending background, so you would have advance fee loan scams. And when I was really sort of earlier in my career, the way that a lot of these would work would be to instruct the victims or potential victims to go and buy gift cards, right? Which, you know, automatically has kind of like a red flag. And there's a certain like, oh, this is kind of like a weird interaction. Why are you asking me to go buy Best Buy gift cards or Apple Store gift cards or, Green Dot money packs was a big one back in the day. I think a couple of the things that have changed significantly that have really escalated the scope of this is there's new technology, right? And certainly the AI stuff that is very top of mind and that Frank mentioned, but there's also new uh, consumer technology, right? So we think about Cash App, we think about Venmo, we think about Zelle, right? And these are, if not technically instant payment rails, they, to the user, they look and feel like instant payment rails and are typically irreversible, as well as the rise of crypto and stable coins, which have certainly helped facilitate taking these scams and fraud and sort of scaling them on this like international scope, which makes it even more challenging for law enforcement and for regulation to try to get their arms around. I think, Trish, to one of your specific questions, we certainly have seen in the US a lot of political as well as regulatory attention on to what extent peer-to-peer payments and specifically Zelle, given that Zelle is owned and operated by EWS, which in turn is a bank-owned consortium, we have seen a lot of scrutiny around liability and reimbursing customers and a lot of pressure. I do think it's important to delineate between fraud or unauthorized transactions where consumers have explicit protections under the Electronic Funds Transfer Act and Reg E, which implements that law, versus scams, or in the UK, you'll often hear the term authorized push payment fraud. But basically, as a consumer, I was tricked into doing something, but I am in fact, the one who sort of pressed OK, pressed the button. I think some of what I've noticed, just sort of like anecdotally in the market, is FIs putting more speed bumps, basically adding friction into some of these processes. So very briefly, and this is literally me observing as a user, as a consumer, I use Chase in the United States when I'm there, and for its Zelle UX, it'll actually add a certain, warning modal, especially if you're trying to send money to somebody that you have not previously sent money to, being like, do you really know this person? This transaction is basically the same as cash. Once you do it, you can't get it back. I've seen similar warnings in Wise, the international remittance platform. And in Venmo, again, if you're sending money to somebody, I believe if you haven't previously transacted with them, it'll ask for like, can you confirm that you actually know this person's phone number or know this person's email address to try to validate, like, yes, you are sending money to the person you think you're sending money to. So on the one hand, I think that is a positive that, fintechs and banks are responding to, I guess it's difficult to say if they're responding to their customers being scammed and defrauded or if they're responding to regulatory and political pressure. I guess probably a mix of both of those things. I do think the question of, is that enough? Is unanswered. I mean, the sort of ability to automate and scale these operations through the use of tech, through the use of AI, and then particularly if it's coming from outside the United States, and there are a lot of these operations that are based in Southeast Asia, it becomes very, very difficult to try to activate law enforcement or get that money back once it's gone. So I certainly think we've seen some progress in the US. In the UK, of course, you've seen a new regulatory regime around reimbursing certain kinds of scams. But I imagine depending on what administration is in power in 2025, I expect we'll probably continue to see scrutiny on this topic.
Absolutely. The UK is such an interesting experiment where I would say that it's really the first major nation to provide liability to the or to give push liability to the financial institutions for scams. And it is going to be really interesting to see how that plays out. And like you said, Jason, this is something that is top of mind and has been talked about in Congress for now several years. So it'll be exciting to see where things shift. Um, and thank you for bringing awareness and education as a big way to combat scams. Uh, Chris, what have you seen clients implement to help combat scams? What is maybe the one most effective method you've seen?
Yeah, well, I think I would say one that Jason touched on already, which is that whole friction element, right? Which is really making sure that that customer, knows the consequences of the action they're taking. And friction in the customer experience thing is traditionally and probably continues to be one of those ones that is like many firms feel somewhat allergic to the idea of like a frictional, wait a minute, I have to add another step here or another disclosure here. Like, are we sure I need to do that? Is it okay if we can tuck that disclosure somewhere else or some other, FinCEN type notification or something in a bank account opening process? I think similar to my comment earlier, that line is shifting a little bit and people are recognizing that one trades off friction and cost in two different ways, right? The friction of maybe customer acquisition and customer satisfaction on one end, but that additional little bit of friction saves a lot later. So we're definitely seeing more of that in our interactions with fintechs. And I think, a few years ago, they would have been perhaps more likely to push back on the idea of like, are we sure we need to add this extra step here? And now it's like, well, where's the right place to add that step? And
well, and Chris, I mean, to your point, if the customer is, convinced that they want to make this transaction, the last thing they want to hear is, no, you can't do this, or no, you shouldn't do it. I mean, there was a really upsetting story in Bloomberg, I think, over the summer about an elderly woman who was scammed and physically went into a bank branch again and again, taking out large sums of money. And on the one hand, it's like, should the bank have been able to detect that like this was far outside of her typical usage patterns, withdrawing all this cash or making these transfers? Yeah, but at least per the Bloomberg report, when they sort of gently push back on her, she's like, "Oh no, like I know what I'm doing. I'm authorizing this transaction." So it does sort of go back to that question of like, who's ultimately responsible and where do you draw the line on liability? And I feel like that is the messy, perhaps unpleasant process that is sort of being negotiated now in the market.
Yeah, I think one of the things that's to me is very interesting is what's happening in the UK with the reimbursements were put in, and in parallel, they're going to have a 4-day hold. So banks will have the option to hold a payment, an instant payment for up to 4 days. So what we're going to see is, if we look at credit cards as an example, where banks are responsible to reimburse, they end up on average declining or holding about 50 basis points to 1% of transactions in real time, meaning that you'll get a decline because the bank considers it very high risk. We'll probably see in the UK the same numbers. We may see about 0.5% of payments or maybe up to 1% get held. And what we're going to see is a shift in consumer sentiment where it'll be, hey, you're blocking my account. I want the payment to go through. So there's going to be this reverse effect where if you're going to hold a bank responsible to reimburse, they're going to treat it like their own money, and it's going to become a statistical problem for them. What's the odds that this is fraud or scam? If it's a scam, I'm going to block it because it's not your money anymore. It's my money that's at risk. So we'll just see the banks taking a much more proactive approach, but there's going to be consumer friction. That's going to be the next wave of complaints is not going to be the reimbursement. It's going to be about holding the payments. So I think it's going to be interesting to see how that develops.
Yeah, absolutely. I think it's really interesting to see the reaction and the downstream effects on consumer experience, and the UK will be a really interesting testing ground for this. And Frank, before we move on to the second trend that we are seeing from this report, what is your recommendation for fintech companies on what they should implement in order to um, stop scams from happening?
Well, I think you use your existing fraud systems that catch fraud really well to catch scams and interdict on those scams. I think the only way that we're going to really take a bite out of the scams is if banks are able to kind of apply some of their knowledge on fraud to go beyond what they're doing for fraud. So if you see evidence of a scam, you have to do some interdiction. You have to block the account, contact the customer. There's an interesting stat up here. It says number one, most time-consuming fraud. That's absolutely true, right? And I think, Jason, you brought it up. If you're trying to break the spell of somebody that is under a romance scam and you have a call with them, that can take hours to convince them that the payment is going to be fraud. So I think in addition to kind of using your fraud systems that you use or your rule-based systems to stop scams, is have a targeted team that knows how to deal with these victims and to break the spell, right? To have those conversations to convince them not to send the money. That would be my advice.
Absolutely. Great. Well, thank you all for chiming into this topic. It's a really big problem. It is horrible to see, when we see scams every day. We see people lose their life savings, people get tricked into believing that they want a romantic relationship, but it was a complete scam. And the problem, of course, affects fintech companies because there is definitely a worse customer experience, potentially loss of funds as well. But the problem in society is really large because what that really means is trust in the financial ecosystem. So um, it's really important that as a community, we are proactive about it and not waiting for Congress to change its to pass a bill, but rather um, we do the right thing by our customers because that is the best for the fintech company as well. All right, okay, let's move to the second trend that we are seeing, which is resource intense AML. And what we are seeing is that AML is becoming an increasing challenge for fintech companies. We are seeing a very big rise in the SAR filings year over year from fintech companies. And then also we are seeing a lot of fintech companies or their sponsor banks work through consent orders, which of course demand a lot of time, a lot of attention, a lot of resources. Jason, I want to call on you for this and get your perspective. You've done a lot of great work here uncovering the challenges with the current fintech and sponsor bank model. So, can you share for the audience, firstly, what are the problems that with the current setup? Why is it problematic? And what are some of the challenges that you were seeing from an AML perspective for these companies as well?
Trish, we only have an hour. I can't get in all the problems. But in all seriousness, I'll call out sort of two specific things. The first being, I think historically, a mismatch between expectations and incentives. And this probably isn't super surprising or rocket science, but particularly, early stage fintechs, their number one goal is to grow quickly so that they can go and raise more VC money so that they can continue growing. And too often, and I do think this is beginning to change or has changed to a certain extent, but too often things like compliance or things like adding the kinds of friction, whether that is upfront at customer onboarding, account opening, or whether that is transaction monitoring and the type of interdiction, whether that's from a scam perspective or from an AML risk perspective, were viewed as generating a negative customer experience, and those functions sometimes are thought of as cost centers, right? It's expensive to hire good compliance people. It's expensive to onboard good AML vendors. And I do think that attitude has begun to shift, both due to the consent orders and enforcement actions that you referenced, um, as well as sort of a changing attitude about the growth at all cost mindset versus the pressure on the economics, which there is an interplay right between fraud, scams, AML. And the actual like P&L of some of these businesses. So that's sort of like one bucket where I think we have seen some progress, but I think there remains sort of an inherent tension between a non-bank fintech that wants to grow very rapidly and their bank partner or partners' ability to scale the necessary supervision or compliance function to match that rapid growth. So that's sort of like one bucket. The second bucket, and I will try not to go too far down the FBO rabbit hole because I know that's not that's not the primary thing we're talking about. But the way that a lot of these non-bank fintech programs have been structured can make it more difficult for a bank to exercise its regulatory to meet its regulatory obligations as far as BSA, AML, CFT, Patriot Act, any other acronym you want to throw in there. And just to illustrate some of that complexity, right? It's not uncommon for a fintech, whether that is a customer-facing fintech or a middleware platform, to use one or multiple FBO accounts that are actually commingling funds and transactions potentially for numerous fintech programs if it's middleware in play, and certainly for thousands, tens of thousands, potentially hundreds of thousands of customers who are transacting through that account. And that, just from a sort of data hygiene, data visibility perspective, certainly makes it far more difficult for a bank to understand what is happening through its payment rails and what's happening in the accounts that it's hosting. So I think there's more, but I think those are probably two very top of mind examples of how fintech and some of the structures that American fintech has come to depend on makes AML compliance and transaction monitoring as a subset of that more challenging.
Absolutely. And thank you for shedding light into this for the audience. One thing that you mentioned, which is, resonating in the data, is almost 1 in 4 fintech companies are going through regulatory action, like consent orders. And when I started this company, um, almost 6 years ago now, that was not the case. That was definitely, it wasn't as prevalent in the fintech industry. So I'm actually curious. You talk a lot about this in your writing. How has the regulators' perception, according to you, um, how are they thinking about regulating the fintech industry?
Oh, that's also worthy of multiple webinars of its own. Um, I mean, I think the challenge with the current environment, and I am always careful to sort of caveat, you know, we tend to talk about regulators, and I use the same language, but in the U.S., we have the fun of dealing with numerous regulators, right, at the federal level, the Fed, the OCC, and the FDIC in the banking space, as well as numerous other regulators, plus CFPB from a consumer compliance standpoint. And then, 50 plus state and territorial regulators, if you're talking about state banking licenses or MTLs, money transmission licenses, FinCEN, numerous others. So there's always a little bit of flattening when we just talk about like, how are the regulators viewing this? But I will do my best to answer that question. I think um, at the current time, rightly or wrongly, the whole sort of Synapse disaster and the fallout from that is very top of mind. The most visible portion of that certainly is the consumer harm, which is a bit outside the topics we're discussing today. But you know, I have to imagine that the prudential banking regulators, FinCEN, policymakers are also paying attention to the AML uh, gaps that existed in that situation and sort of thinking about what, if any, are the correct policy responses to try to address those types of situations. So, for example, what p- people, including me, are sort of referring to as the synapse rule. Fundamentally, that's about reconciliation of funds between third-party ledgers and the bank that's hosting the FBO accounts. If I try to tease a lesson or a theme out of that is more directly applicable to the conversation we're having, it's this idea of what is happening inside of the bank regulatory perimeter versus what is happening outside of the bank regulatory perimeter. And so, in the context of these bank fintech partnerships, if a bank is relying on one or multiple third parties, whether that's a middleware or a non-bank, customer-facing fintech, to fulfill these AML obligations, I do think you're going to see more scrutiny as far as, is that operating model fit for purpose? And you mentioned the plethora of consent orders, almost all of which touch on BSA AML compliance. I wouldn't be surprised if we see some kind of rulemaking touching on these topics at some point in the future. Chris probably
Absolutely.
knows better than I do.
Chris, what do you think? And I'll say that I remember a couple years ago we launched our sponsor bank product, and really it's a parent-child kind of organization of the data that you can have multiple different children, which would be your fintech companies, and segregate the data and then be able to run rules on that as well as run rules on the parent. But when we were launching that, this was 3 years ago, I spoke to a bunch of sponsor banks, and they all had different ideas of how they should think about who does AML transaction monitoring. And some said, oh, we're going to do everything. We don't care if the fintech does it. Some say that the fintech does it and we just file the SARs. So we don't really do that much of a monitoring on top of it. And then some say that, oh, we do the monitoring and Fintech will do the monitoring, which I would say is really, I think, where we are starting to settle in from as what should be the standard going forward. So I'm curious, Chris, what is your perspective on, you've seen many different types of sponsor banks and their reactions here. Where do you think the standard should be on the responsibility for monitoring?
It's a really good question. I don't know that there is like a convergence of an answer on that yet, although it's certainly a topic in the discourse of where those roles and responsibilities ought to lie. I would make one comment just as I've been listening to Jason. I agree with everything he's said, and you too, Tricia, so far. But as I've been looking at the screen here, trying to parse through the 23%, the 42%, and then looking back to the left side at 46%, it it makes me think that there's a bit of a virtuous circle going on here, which is that these consent orders are terrifying, rightfully, for those going through them. They're time consuming, they're costly, but they also appear to work in many cases. And with 23% of these fintech respondents saying they're currently working through an action, almost half, or 42%, are saying it's time consuming. I suppose the other 58% haven't faced it yet, or maybe just aren't necessarily responding to that. Well, we're not actually subject. I haven't been subject to one, so I'm not in a position to say whether it would take more or less time. I think 100% would say they actually do take a significant amount of time and resource. But the delta between 23 and 42 is like 19%. So 19% of the respondents here seem to have been ones that understand that it's resource intensive and are not currently under them. They probably were previously under, working with a bank or another financial institution that was subject to some enforcement. And simultaneously, we're seeing an increase in the volumes of SARs being produced. And I think it's that investment in technology and process and training and people and capabilities that is leading to that uptick in suspicious activity filing, whether it's the UARs from the fintechs to the banks, or from the bank, and then the SARs from the banks and credit unions to FinCEN, and of course other financial institutions that file with FinCEN. But as a thing, this seems to be working. As for the specific contours of who should be performing the monitoring, should it solely sit with the fintech? Should it sit with the bank? I think at the end of the day, the bank is going to feel that they have to answer for the things that they're accountable for, and get comfortable with the way in which they have command, and at least an understanding, command and control, as it were, over the activities that are transiting through their institution, and be able to answer for that. And that means if having the fintechs do the monitoring, in many cases they probably are the right ones to do it, there needs to be that third-party risk management oversight of that fintech, and all those sort of traditional discipline and rigor around that. I do tend to push back on this idea that somebody out there, be it a supervisor, examiner, or regulator, or in the policymaking space, legislative space, are trying to throttle fintech as a thing. I think broadly, innovation is supported, but it's responsible innovation as the order of the day, as it were.
Yeah, absolutely. And it is important, as we've seen in the case in the last several months, it is important from a consumer protection perspective to have oversight here. And it'll definitely, I think what would be great from a regulatory perspective is more color on this is exactly what we would like you to do. I think that'll be better for the entire fintech community.
One thing, Trish, I was gonna jump in and add something. Is we've actually seen this before. If you go back to 2006 and 2007, here in the United States, SAR filings for the mortgage industry increased 7x because of the same thing. The government came in and said, "Hey, you got to do more to stop this mortgage fraud." So we saw this huge spike in SAR filings. Gradually, it came back down, but it was basically a recognition by these mortgage companies and these finance companies that there was a lot of fraud that they weren't reporting. And during that process, it was a 2-year period, just a huge spike in SAR filings. It came back down, but still, this is something, history kind of repeats itself. So we're seeing the same thing happen in fintech that we saw in mortgage, 15, 20 years ago.
Yeah, no, that's a really great point. And thank you, Frank, for putting that in historical context, that this is not the first time that we are seeing this. And on that note, what is one recommendation from all three of you on, okay, we know this is becoming something that the scrutiny is only going to increase, which means more resources are needed. How can a fintech company, and Jason alluded a little bit to it, the running often on VC funds, not profitable typically. How can they use their limited resources to make sure that they are tackling this properly. So, what is the one recommendation from all of you on what you would advise a fintech company to implement?
I mean, this might not be the I don't know, sexiest answer, but, I would view, um you know, building the proper systems, processes, staff, tooling, vendors, whatever, whether that is at the fintech level, at the middleware level, if applicable, and or at the bank level. It's always very tempting to only think about that as a cost center and thus, try to uh optimize, and too often optimize means minimize that. I think the reality, particularly on the fintech side, for founders or for executive management who may not have as long of a history of experience in the space, is to understand that enforcement actions, consent orders, regulatory actions are pretty much by definition backward looking, and regulators do often move slowly, but that does not mean that they do not move and that there are no penalties, right? I mean, so many of the consent orders that we've seen in the past 2 years stem from multiple years prior. And that's just, at least definitely within sort of like the banking world, and how banking enforcement actions move from a supervisory matter, an MRA, MRIA, through to actually become an enforcement action or a consent order. That process can take years. And so for fintech, non-bank fintech teams, executives that maybe are from out of category or are earlier in their career, understanding that, cutting corners or trying to minimize costs now in order to maximize your runway, minimize your burn, like that all makes sense. I understand the pressures that they're facing. I've done my time in early stage startup world, so I do get that. The problem is, if you cut those corners now, you put up some great growth numbers. It could be 2 years, 3 years, 4 years, and all of a sudden, some decision you made, let's say hypothetically, allowing registered agent addresses and not collecting a physical address for your customers, because that seemed like a good way to goose your growth numbers, could come back to cause you a lot of financial cost as far as remediating those problems, reputational cost, introduce major friction with your bank partners who are, you know, absolutely number one most critical vendor as a non-bank fintech you could ever have. So you know, looking only at the financial cost of building a robust, compliant, risk-based approach, ignores the potential negative consequences that might not be realized until years in the future. No idea if that answered your question, but I hope it did.
Well, I love it. You invest early so you don't have to invest later. You don't have to invest more later. Awesome. Thank you, Jason. Chris, and Frank, what are two things that you feel, or one thing each, but for that you feel would be really useful for fintech companies to implement today to make it less resource intensive?
Um, to reiterate, yes, I think Jason did answer the question, because I would have said embedding compliance early as my answer to that question had I been picked that first. So let me think of something else. I think as it relates in this, so I think fits with that broader sort of leitmotif of embedding compliance and really like being thoughtful and mindful about it, is really understanding for each of these fintechs, like what are the risks that their business faces, and how could somebody abuse their platform and abuse their users and customers, and really building around that, and selecting systems and implementing those systems in ways that are tailored to address the risks that platform faces. Because you'll see tons of instances of, and we'll I think we'll come on to it later. The idea that like if it was set up badly or you just threw some rules off the shelf on a tool, you're going to deal with some of the consequences of that, which could be false positives or volumes and things you're having to deal with, and you might not be detecting the things that actually matter. So I think in a couple of words, I think the phrase I'd throw out here is risk assessment. It also happens to be consistent with FinCEN's notice of proposed rulemaking from this summer for financial institutions that will actually codify the requirement to conduct risk assessments, where historically, I think for those of us who've been in this space for a while, risk assessment's a bit par for the course. But it is nice to see it actually codified now, or will be codified, and some guidance, or at least a bit of guidance about what that sort of risk assessment should entail. But those of us who are shooting for risk-based programs, and I think most people are, then understanding where those risks are and building and addressing around those will pay dividends, downstream.
Yeah, I love what you said, Chris, about really customizing it to your business. That's a big product philosophy of 21 is customizability. You can customize the data you send, the rules you write, the workflows that you have. And it's really important that you don't monitor the same way as your credit union down the street monitors. If you are a fintech company that has a crypto product, a brokerage product, an international remittance product, you have a different profile, not only of risk, but also of the type of data that you get, which is important to ingest that and make sure you're monitoring that. Thank you for sharing this. And Frank, would love to get your thoughts on what is one thing that a fintech company today should implement to make this less resource intensive?
Yeah, so the only thing I would say, I think the only thing I'd add is don't do the bare minimum right now, because once the regulators are focused on you, they're going to keep coming back every quarter, every year, and looking at what you're doing. So you got to have your team established that's working those queues. So if they have an AML queue, make sure that those are getting worked every day. Don't clear out the queues at the end of the month because, we didn't get to them. Don't try to clear out, things that are going to reduce too many false positives right now, because regulators don't care about false positives. They just want you to do the same thing on everything. So I think it's just the main thing I would recommend is get those resources on those queues and don't clear them out just because you didn't get to the work, because that will come back to bite you later.
Yeah, really, like think long term. Think about not what is happening today, but the problem 3 years down the line. And what we are finding is we recently launched an AI agent, and the concept is you can give the AI agent tasks. And so you can give it a certain set of tasks for your sanctions queues, for your TM queues, for your elder abuse queues, however you want to slice the queues. And you can say, okay, for my elder abuse queues, I want you to look at 3 things. Look at is this the first time that the user has initiated a payment to this individual? Look at if the user's had any decline transactions in the past, etc. And it will complete that, and the AI will give it to the human. And then the human makes the final determination on the alert. But a lot of the manual tasks of information gathering is completed by the AI. And we have seen 10x reduction in alert handle time. And we feel like that is a really good way to leverage AI, where it's not just doing a bunch of things and your goal is, I don't want a compliance team. Like, you're gonna have a compliance team. And really the question is, how can you leverage automation and efficiency the most so that you don't just, to Frank's point, try to reduce false positives in a way that is not going to be really consumable by regulators. So the automation is something, and we've demoed this to several regulators. The automation is something that regulators are more down for. And so really that should be the investment, is in to tools and technologies where you can automate more, instead of saying, I don't want to look at this because this is a false positive. All right. And let's quickly cover the third trend, which is impact of real-time monitoring. What we have seen is that today we have 64, about 2/3 of fintech companies have implemented real-time monitoring to identify fraud in real time. And of those who implemented real-time monitoring, um, almost all, 95% have seen improvements in their fraud programs, 56% saying that they saw significant improvements. So real-time monitoring is really a competitive advantage where you can respond to fraud more quickly. Frank, I'd love to get your thoughts on real-time monitoring and real-time payments. What is your perspective on two things? One is where do you see this going? And secondly, what is the difference between a fintech company that implements it well and that one that doesn't? And what would be your advice to them?
Yeah, so I've got a lot of experience with real-time monitoring. Did a lot of consulting with banks primarily when in the early 2000s when they were going from kind of batch mode or one back mode into real time, where you can actually look at a transaction as it's occurring and make a decision in real time. And it was unanimous just across the board. If you're using real-time monitoring, you're going to improve. Using the same rule, you're going to get a 50% increase in fraud reduction. And I think it looks like these stats that you're showing here on the screen completely align with that. So I think real-time monitoring is like the number one thing you can do, right? It's giving you the most possibility to reduce the fraud and make a decision so those funds aren't going out. And in payment monitoring and anything where the payments are going out immediately, this is a critical must-have.
Absolutely. Chris, I'm curious, when fintechs come to you and talk about real-time monitoring, what are the biggest challenges that they have in implementation of this?
I think for a lot of our clients, they're sort of in exploratory mode, and they're looking for ways that are going to be most effective for them without necessarily, especially with the early stage ones, they don't necessarily have the existing history and data and sort of lost data to understand how much that investment is likely to sort of pay off in the ROI, as it were, for going more real time. And so a lot of it's kind of understanding what are the possible technologies out there, how can we implement them, what does that look like to us, and what is the workflow on our side from the employee experience side, what is the customer flow and experience there, and what are the likely sort of pros and cons. So we do spend a fair bit of time analyzing those for our particular for clients, and helping them make that decision as to whether they ought to go real-time monitoring or not and wait a little bit longer. Looking at data like this, it's hard now. I think I'll be hard pressed to advise somebody to wait and not think about interdicting as soon as possible within that flow.
Absolutely. And Jason, in your newsletter, you talk a lot about real-time payments and the proliferation of that. Can you share a bit more on where do you think real-time payments is going to head? Because real-time payments is really a big reason why real-time monitoring is implemented. You don't really need it for checks, as an example. So where do you think RTP is going?
Yeah, I mean that is exactly the direction I was going to go, right? So, it's one thing to say, bank branch is open Monday to Friday, 9 to 4:30, or whatever the time is these days. But with whether it's Zelle, which is like a bit distinct, or the two real-time payment networks, one operated by the clearinghouse, RTP, or FedNow, which is slowly but surely gaining adoption. I think your point is exactly right. And it's like, if you're going to offer these capabilities, does it make sense, and is it appropriate to be doing your monitoring on like an end of day batch basis? I mean, I am, a bit sympathetic, particularly to on the bank side, the difficulty of moving from that sort of like 9 to 5 close of business, run your batch processes in your FIS, Jack Henry, Fiserv, whatever core, to now we need to be able to monitor in real time whether that's for the fraud, AML, sanctions kind of cases that we're discussing, or even from like a balance sheet liquidity management standpoint. Like I need to be able to know what is happening in my bank's balance sheet and in, incoming and outgoing transactions in real time for a whole bunch of reasons that, even as recently as like 5 or 10 years ago, maybe you didn't need to if everything was, batch ACH or, oh, well, sorry, you missed the wire cutoff because it's past, 5:30 p.m. on the East Coast. Um, the capabilities, I think, are moving more quickly than most financial institutions' ability to monitor for the kinds of things we're discussing. And that poses, creates gaps and poses risks both in a very narrow sense of like an individual bank or an individual fintech, but then also at like the aggregate system level of, um, you know, sort of facilitating or enabling some of the financial crime that we've been discussing, right? And so, to be able to better police and better mitigate that risk, again, at an individual institution level and then at an aggregate level, you need to have tools that match the speed that the fraud and that the scams are happening at.
Absolutely. And I'll say this is something that it's great to see the degree of adoption that fintech companies have for real-time monitoring. Banks, it's way less. And when we compare it and slice the data in this report, what is interesting is that fintech companies here are moving faster. It is a competitive advantage for fintech companies. And fintech companies really need to make sure that they are thinking about the liability, the AML concerns more in order to ensure that they stay competitive in the long run. All right. So those are the top trends. We had a quick bonus one that we'll cover in a couple minutes, which is the hidden cost of false positives. We won't spend too much time here, but false positives is a really big issue today in this industry. Today, if you are 9 out of 10 alerts that you review is your noise and garbage, what that means is that your team is on nonsense. And I completely agree with Frank that you can't make it 100% true positive rate because it really will get regulators interested in how you're monitoring and making sure that you have implemented this well. But false positives does have a really big cost, and it is correlated to how effectively you can be building rules well. So we won't dive into all of the data, but I wanted to talk a little bit about what one of the aspects in this bonus trend, which is today we find when we're looking at how rules are built and deployed, um, we have about FRAML teams are able to deploy rules um, quite effectively on their own. They don't need to rely on engineering. They don't need to rely on third party and AML teams, but fraud teams not so much. Fraud teams mostly do rely on others to be able to write rules. And what is most interesting, and Frank, I'd love to get your thoughts on this, is AML, the rules don't change every day, but fraud, the rules change every single day. So I'm curious, Frank, what is your perspective on this data and what does this mean if fraud teams that actually need to be able to quickly deploy things are less effective than AML teams?
Yeah, I mean, I look at this chart on the right, and it says that I don't know exactly how to interpret it, but it looks like a lot of these rules that the fraud team wants are taking over a month to implement. And if you think about a fraud scheme where somebody's attacking your fintech with a payment scheme, if you're waiting 30 days and you're losing $100,000 a day, that's a huge cost, right? And so in fraud, timeliness is very important. If you have a fraud rule that's going to prevent losses to your fintech, you need to get it in the same day or the next day, which is, I think, the speed to deployment is so important. And the rules in fraud can be quite different. I think the fraud rules are probably more attuned to the real-time monitoring where you're actually going to be blocking accounts. So I can see why there might be more caution on some of the fraud rules, but you've got to have a system, you got to have a platform that's going to be able to allow you to deploy those, test them, and get them out right away.
Absolutely. And thank you for sharing that. It's really important as companies are selecting their transaction monitoring tools and vendors, they are able to find one that is able to genuinely um, you can deploy rules quickly because if both the fraud and the AML teams are using it, it is super important to be able to do that.
Mm-hmm.
So great. Well, we're over an hour, so we're going to wrap it up. I want to firstly thank all of you for taking your time and providing your insights and expertise to the audience. We covered some really interesting content. Scams is rising. Everyone needs to take it really seriously, even if you don't have liability today. The second is scrutiny on how you're doing AML is only going to increase. And the third is real-time monitoring is really, really crucial to have in place. If you don't, it is a very big competitive advantage for fintech companies. And as a bonus, false positives is something that is top of mind for a lot of companies, and the ability to write rules and respond to it quickly is again very important. So thank you all for taking your time. As mentioned before, the full report with all of the insights will be live at Money 2020, October 27th. So please keep an eye out for it and tune in to get all of the findings. Thank you again, everybody, for your time.
Thank you.
Thank you.